Unit trust, index funds and ETFs. What are they? Are they the same thing, or is there really a big difference between the three? Hey guys, Pieter here. In today's video, I'm going to explain exactly what unit trust, ETFs and index funds are, how they are similar, as well as how they are different from each other, and at the end, I will give you a solid motivation backed by numbers and research, of course, of why passive funds are better than active funds. Whew! This is a hotly debated topic. So I'm really excited to share with you guys what I found. Alright, so crack open a cold one and let's get into this video. So let's start with unit trusts, also known as mutual funds in the US. The unit trust industry was started as long ago as 1931 and provided a means for different investors to pool their money together to buy a certain group of local and international assets, which are usually a blend of shares, bonds, property and cash. The unit trust fund acts as a basket in which all these assets are put into, and it then makes it possible to sell a small piece of the basket to investors, which are called units. So basically, instead of buying individual shares in 100 different companies, unit trust made it possible to buy a single unit that owns shares in all 100 companies. So if you own a unit, you own a small piece of every single company inside the unit trust. This form of investing really revolutionized the investment industry, as it made investing much easier and accessible, a lot less admin intensive, and provided a great form of diversification to investors' portfolios. Diversification is important, as say you invested all your money into one company and then that company went bankrupt, you will lose all your money. But if you invested in a unit trust that contained shares in 100 different companies and one of those companies went under, the other 99 will still be able to carry you, and thus the negative effect on your investment portfolio will be much less severe. Now, unit trusts are mostly managed by a fund manager who is a very smart guy or girl that chooses which companies should be included in the fund. And they usually spend most of their day analyzing a bunch of charts and will buy and sell individual shares based on what is currently happening in the world. The idea behind this is to buy when shares are low or undervalued and to sell when they are overvalued, in order to try and give the investor the best returns when the markets are doing well and to protect the investor when the markets crash. This does come at a cost though. And this cost can easily eat away at your investment performance in the long run if the fund is performing poorly. And for this reason, some investors were starting to complain that unit trusts were just too expensive and that the promise of higher returns did not justify the higher cost. So in order to combat these high costs, ETFs or exchange traded funds were created in the 1990s. Now, in order to understand how an ETF works, we first need to understand what an index is. Say I want to establish how well the top 40 companies in South Africa will perform over the next 5 years. What I will do is I will track each company's value every single month, chart it down, and then after 5 years, I will be able to dot a graph showing each individual company's growth. Now, if I want to know the average growth of all 40 companies combined, I will need to add these numbers together and then divide it according to how much weight each company has within the group. Say, for example, company 1's value makes up 10% of the total value of all 40 companies combined, then company 1's value will be multiplied by 10%. And if company 40 makes up only 1% of the total value, then company 40's value will be multiplied by only 1%. This will finally give us an accurate representation of how all 40 companies combined performed, meaning it will give us a weighted average over the entire 5-year period. And this is basically what an index does. An index has a set of predetermined rules that tells it which companies it needs to track and which companies it doesn't. In this example, the rules of the index will be to track the top 40 companies in South Africa weighted by market capitalization, meaning how much they are worth. So if company 41 develops a higher market cap than company 40, then the index will boot company 40 and will include company 41, as this will satisfy its rules of only tracking the top 40 companies, not the top 41. Now, all that an ETF basically does is it tracks a specific index by piggybacking and replicating what the index does. In this example, the Satrix 40 ETF will track the JSE Top 40 index. So if this index removes company 40, then the ETF will sell its shares in company 40. And if this index adds company 41, then the ETF will buy shares in company 41. So for this reason, an ETF does not need an expensive fund manager that actively decides which shares to buy and sell, as all it does is it tracks an index and does what the index does. This saves the investor exorbitant fees and will always deliver average market returns, as again, all it really does is it tracks the average market performance of whatever the index is tracking. And then we also get index tracking unit trusts, also known as index funds, which has been around since around about the 1970s. An index fund is basically the love child between a unit trust and an ETF. They function very similar to an ETF in that they track a specific index rather than being actively managed, and they also bring about a lot of diversification at a very low cost, thereby making them much more competitive with the costs of ETFs than traditional unit trusts did. Alright, so now that you have a basic overview of what a unit trust, index fund and an ETF is, let's look at some of the similarities between the three. All three are known as collective investment schemes and are governed by the Collective Investment Scheme Control Act. That's a mouthful. This basically means that they are all pooled accounts, which means many people can pool their money together to gain access to the stock market at a much lower cost in order to buy large and expensive stocks such as Apple and Naspers. All three offers investors access to the performance of a well-diversified underlying pool of assets via a single transaction. They are all heavily regulated by the Financial Services Board in order to protect the money of retail investors, which will be you and me. All three can be easily accessed by the man on the street, as they can all be bought online. The tax treatment for all three of them is almost identical. All three can be wrapped in a tax wrapper, such as a tax-free savings account or a RA, and all three give the investors the option to choose whether they want to receive income, like dividends and interest, paid out by the fund into their bank accounts, or whether they want it all to be reinvested in the fund. Now let's see how these three are different. With ETFs, you buy shares in a portfolio or fund, whereas with unit trusts and index funds, you buy units in a portfolio or fund. ETFs are always passive index tracking investments, whereas unit trusts can either be actively managed funds or passive index tracking funds, which are known as the index funds. An ETF is listed on the stock exchange and are traded just like shares on the stock market, whereas a unit trust is not. With ETFs, you will need to have a stockbroking account to access the ETF, where you will need to give a buy instruction to your broker every single time that you want to buy an ETF. For this service, you will need to pay a brokerage fee for the trade, both when you buy the ETF and when you sell it. In contrast, you can access a unit trust or index funds in one of two ways. Either directly through the unit trust manco or managing company, or through a linked investment service provider, aka LISP, which is basically an administration platform that hosts unit trust and index funds from many different providers, for which you will pay an underlying management fee. The price of a unit trust or index fund is calculated once a day at the close of the stock exchange, whereas an ETF is traded throughout the day. This means, depending on how the price goes up and down, you might win or you might lose a bit of money with ETFs, thereby providing the opportunity to time the market for frequently traded ETFs. Passive index tracking investments such as ETFs and index funds have a risk that it will track an index all the way into the ground crashing. Unit trusts, however, have the advantage of a manager actively monitoring the fund who will be able to pull out your money when the situation in the stock market gets dire, thereby providing a safety cushion during uncertain times. They don't always get this right, and at the end of the video I will explain why. When cashing out your ETF, you might need to wait up to 3 days for the ETF funds to clear and to reflect in your bank account, where a unit trust or an index fund, on the other hand, can clear a lot faster. An ETF must publish its holdings, meaning which company the ETF is invested in, daily, whereas a unit trust or index fund only have to reveal its holdings every 3 months. And lastly, ETFs and index funds are generally cheaper than unit trust at the fund level, as the decision on where to invest don't require fancy analysts. With ETFs, however, you do need to take into account the brokerage fee when buying and selling the ETF, as well as the bid-offer spread, which are often hidden costs and not shown on the MDD. In general, the longer you invest and the bigger the size of the ETF that you choose to invest in, the cheaper an ETF will become. If you skip an investment platform and buy an index fund directly from the unit trust managing company, aka Manco, an index fund can actually work out a bit cheaper than an ETF. If you want to know the exact costs between a specific ETF, unit trust or index fund, then simply request the EAC percentage from the provider. And if you want to learn more about fees on investments and how ETFs compare with unit trust, then make sure to check out this video over here. So as you can probably see by now, the big question of whether you should invest in actively managed unit trust or passively managed ETFs or index funds is basically whether or not the higher fee of the actively managed funds will result in better investment returns. And as we all know by now, ETFs and index funds track a specific index, which is the average performance of all the companies within the index. So your returns on ETFs and index funds will always be very close to the average market returns. Now, for smart active managers, average is not good enough, and they will therefore try to beat the average market returns by picking shares and trying to time the market. And although they try very hard to convince us with smart marketing campaigns that they can actually do this, we need to look at some historical evidence to see if this really is the case. Now, depending on which study you look at, the figures will vary. It's almost guaranteed that studies by active managers conclude in favor of active funds, and those used by passive managers rule in favor of passive or index funds. Now, one useful objective way to measure the average performance of actively managed funds against their relevant index benchmarks is to look at the SPIVA website. In the US, if we compare the performance of the large cap funds to the performance of the S&P 500 over a 5-year period, we will see that 75% of the actively managed funds underperformed the S&P 500 index. And looking at the past 20 years, SPIVA found that slightly more than 86% of all domestic active stock fund managers had underperformed their respective index. But I know what you are saying. Pieter, we don't care about the US. Tell me how our local fund managers in South Africa performed. Now, of the 5 largest funds, meaning Coronation, Allan Gray, Old Mutual, Netgroup and Stanlib in the South African general equity market that has a track record of over 10 years, only one has outperformed the longest running FTSE or JSE all-share index tracker called Griffin. So from these results, we can conclude that you had a 20% chance of choosing a fund that would have outperformed the average market return over this 10-year period. Not the best odds, huh? And these stats are from the biggest players in the active management industry, which are large, established funds with good reputations. So if we include smaller, less popular funds, the statistics will look even worse for the case of active managers. For example, if you go to the SPIVA website and we compare the performance of South African equity funds to the performance of the S&P South Africa DSW capped index over the last 5-year period, we will see that 60% of actively managed funds underperformed the S&P South Africa DSW capped index. So this research from Spiva tells us that relatively few active managers are able to outperform passive managers over any given period, whether it is short-term or long-term. But the true measure of successful active management is whether a manager or strategy can deliver above average returns consistently over multiple periods. Demonstrating the ability to outperform repeatedly is the only proven way to differentiate a manager's skill from luck. Right, so let's look at some more statistics. This table from Spiva shows that only 0.18% of 571 funds in the US stayed in the top 20% best performing funds over the course of 4 years. And similarly, in South Africa, only 1.11% of funds that managed to outperform the markets once managed to do so for 3 years in a row. So, was their initial outperformance skill, or was it perhaps luck? In my opinion, skill will produce the same results every year, while luck will only last you so long. So yes, it is true that some active managers will outperform the market, but the trouble is you never know which one will when you're about to invest. And even if a manager outperforms the market this year, there is no guarantee that he or she will be able to do it again consistently for the years to come. And to top all of that, one of the greatest active fund managers of all time, Warren Buffett, famously gave the following advice in 2013. My advice to the trustee couldn't be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. Now, even though this old toppy made a fortune for his investors with active fund management, he believes that most people will be better off by simply choosing a passive index fund and some bonds for diversification against market volatility. Now, when a manager as successful as Buffett and an icon of active investing starts directing investors towards the competition, we should be paying attention. Now, although the markets can be quite volatile in the short term, the markets do always eventually go up. So, in most cases, the average person would be far smarter for thinking that he's not so smart at all and just invest in the ETFs or index funds that deliver average market performance. But seeing that 80% of active managers underperform the average, you will secretly be far smarter than most people, because average, in this case, will already put you in the top 20% of investors. So, for me, I'm happy to be average and follow the market wherever it goes, as over a long investment period of over 30 years for me, I'm pretty sure that low-cost index funds or ETFs will perform better than actively managed unit trusts, net of fees. Now, whether you choose to invest in an ETF, unit trust or index fund will depend on your specific investment needs. If you would like to have an expert to actively manage your asset allocation inside a diversified fund and you don't mind paying the extra fee, then a unit trust will work best. If you don't believe that the extra cost will justify better investment returns, then an index fund or ETF will work great. ETFs can be traded multiple times during the day, so if you have some day trader blood in you, then ETFs will be better suited for you than index funds. But there's also nothing wrong with owning both active and passively managed funds. Passive for the low cost fees and active for some downside protection and the potential to outperform the market average. For me personally, I will give active fund managers, who as we've seen will have about a 20% chance to beat the market, 20% of my investment allocation, with the rest of the 80% going into low cost ETFs that I manage myself. It will be really interesting to track the performance of both over the next 10 to 20 years to see who did best. And if I still have my YouTube channel by then, I would definitely like to share my results. Thank you for watching this video, guys. I hope that you find it quite interesting and that you have a better idea of how to choose between a unit trust, index fund and ETF. And if you found this video to be helpful, I would really appreciate it if you can just drop a like so that the YouTube algorithm can push this video out to more people, as that really helps to motivate me to make more videos. And if you are new to my channel and you like these kind of videos, then click on the subscribe button, as I'll be making quite a lot of videos on ETF investing in the future, so make sure that you don't miss out. Anyways guys, that is all for today. Thank you for watching and I'll see you in another video next week. Cheers.